Today, we're doing a complete breakdown of IAS 1. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying international financial reporting standards, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before IAS 1, financial statements were the Wild West. No consistency, no reliability. Imagine trying to compare two companies with different income statement formats. IAS 1's standardized presentation, enhancing comparability across borders. You'll grasp how this standard creates a coherent framework for presenting financials, impacting every public company worldwide. IAS 1 tackled the chaotic financial statement presentation before its existence. Companies followed different formats, leaving investors struggling to compare results. With its establishment, a complete set of financial statements became mandatory. This move enhanced transparency, allowing investors to make informed decisions with comparable, reliable data. Uniformity was the key achievement. IAS 1 is mandatory for entities using international financial reporting standards, impacting public companies worldwide since January 1, 2009. A true and fair representation of financial performance is the cornerstone. Companies must disclose accounting policies, significant estimates, and judgments. This transparency fosters investor trust and ensures financial statements are both reliable and comprehensible. Uniformity in reporting practices is vital. The core presentation model under IAS 1 demands structured clarity in financial statements. It specifies line items, like revenue and expenses, ensuring consistency. Headings and subheadings guide users through financial reports, enhancing readability. Knowing this model is crucial in interviews, showing your understanding of how financial data is organized, crucial for analysts and stakeholders alike. It's about delivering clear, comparable insight. Scope matters because candidates often assume every financial statement is covered by IAS 1. They forget financials made for regulatory eyes only aren't included. This oversight is a prime trap during interviews, where clarity on inclusions and exclusions makes all the difference. IAS 1 applies to all entities creating general-purpose financial statements under international financial reporting standards. It's designed to help shareholders, creditors, and other decision-makers understand an entity's financial health. Publicly traded companies must adhere to ensure transparency. For multinationals, aligning reports with international standards improves comparability across borders, essential in today's globalized economy. IAS 1 doesn't cover financial statements prepared only for regulatory purposes, like tax documents. Small entities not required to use international financial reporting standards are also excluded. Internal management reports and standalone documents intended for specific stakeholders, which don't present a full financial picture, aren't within its scope either. These distinctions can be crucial in an interview setting. Financial statements are structured reports offering insights into a company's financial performance and position. They include vital documents like the balance sheet, income statement, and cash flow statement, along with explanatory notes. These statements target external users, helping investors and creditors make informed decisions. For instance, during a financial year-end, a company's consolidated financial statements reveal its overall financial health, aiding stakeholders in evaluating future prospects. The statement of financial position, known as the balance sheet, presents an entity's assets, liabilities, and equity at a specific date. It indicates financial stability and liquidity, essential for evaluating an entity's capital structure and flexibility. For instance, a tech startup's balance sheet on December 31st might show high intangible assets relative to cash, highlighting reliance on intellectual property and investor funding. Scope edge cases often puzzle candidates. For instance, branch accounts for internal use aren't within IAS 1. Financials drafted just for tax purposes aren't covered either. When a subsidiary in a non-international financial reporting standards jurisdiction uses international financial reporting standards, the main entity is still within scope. However, financials tailored for a specific lender, without broader external intention, might not be. Grasping these nuances can be a game changer in an interview setting. Imagine a world where financial statements varied wildly from one company to another. IAS 1 prevents this chaos by standardizing the presentation of financial statements, ensuring that Meridian Corporation's $10 million SaaS contract is consistently reported and easily comparable to its peers. Let's uncover the backbone of this essential standard. The core presentation model orchestrates the presentation of financial statements into a coherent framework. By following Meridian Corporation's $10 million SaaS contract, we'll see each step, identifying the reporting entity to providing notes, come to life, ensuring clarity and comparability. This process turns complex transactions into digestible insights, making financial analysis intuitive. Let's dive into the specifics, beginning with identifying the reporting entity. Kickstarting our journey, we identify the reporting entity. Meridian Corporation, with its $10 million SaaS contract, is the entity whose financials we're scrutinizing. This step ensures we're capturing the right scope of financial activity. A common trap is misidentifying the entity, skewing insights. International financial reporting standards requires precision here, setting up a solid foundation for the subsequent steps. With Meridian Corporation correctly identified, we move on to pin down the reporting period. Next, we nail down the reporting period. For Meridian Corporation, linked to its $10 million SaaS deal, this means aligning financials with the fiscal year of the contract signing. It's crucial to distinguish between fiscal and calendar years. Mix-ups here lead to misaligned insights. International financial reporting standards underscores the need for consistent reporting periods to keep financial narratives coherent. With the period set, Meridian's financial position takes shape in the upcoming step. Now, we construct the statement of financial position. Meridian Corporation, with its $10 million SaaS engagement, lists its software as a key asset, while obligations form its liabilities. A pitfall is neglecting contingent liabilities, compromising transparency. International financial reporting standards mandates that all material assets and liabilities are accounted for, ensuring a true reflection of financial health. With the financial position clear, we explore profit and loss next. Profit or loss takes center stage as we tally Meridian Corporation's $10 million SaaS revenues, splitting it into $8 million software and $2 million services. Matching these against incurred costs is vital. Misalignments here lead to distorted profit margins. International financial reporting standards enforces these matching principles to present a true profitability picture. Capturing this narrative, we transition to changes in equity. Equity evolves as we document shifts in Meridian Corporation's retained earnings, influenced by the $10 million SaaS venture. Missing equity adjustments can leave gaps in the company's financial story. International financial reporting standards insists on a complete record of equity changes, revealing the true impact of financial activities. With equity adjusted, Meridian's cash flows are next to be illuminated, concluding our journey. The measurement method you choose directly impacts your balance sheet. Imagine overstating assets by millions due to a poor choice. Accurate disclosure ensures stakeholders see the true picture. Let's explore the balance between measurement choices and the essential disclosures required by IAS 1. When you first recognize an asset, you do it at cost, setting the stage for all future measurements. Consider acquiring machinery for $100,000. You record it immediately if the economic benefits are probable and measurable. The rules are strict about initial measurement to ensure consistency and reliability across financial statements. After initial recognition, things change. Imagine revaluing a building due to market shifts. Depreciation kicks in as assets are used, impacting profits. Fair value adjustments might be necessary to reflect current realities. This ongoing process keeps financial statements relevant, reflecting true asset values and liabilities. When you scan a balance sheet, look for assets split into current and non-current categories. Liabilities follow suit, offering a snapshot of obligations. The notes are treasure troves, revealing measurement bases and accounting policies. How revenue and expenses are classified can drastically alter analytical conclusions, guiding decision-makers. Understanding disclosures is non-negotiable. Accounting policies clarify how numbers are derived, essential for consistency. Judgments can sway reported amounts, a critical detail for analysts. Estimation uncertainties give insight into potential risks and outcomes. Tracking changes in these policies over time reveals trends, crucial for strategic planning and investment decisions. A CFO's role involves strategic decisions, like recognizing a $2 million equipment purchase. Revaluation of a $10 million property under changing market conditions can significantly affect the balance sheet. Compliance with IAS 1 is non-negotiable for transparency. Even a $500,000 change in accounting estimates demands a thorough analysis of its financial impact, ensuring stakeholders remain informed. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Accounting for leases under International Financial Reporting Standards requires recognizing a right-of-use asset and a corresponding lease liability at the lease's inception. For Meridian Corporation, this means recording the $1,200,000 lease as both an asset and liability, reflecting the economic reality that the company now controls the asset in exchange for future payments. Each monthly lease payment reduces both the lease liability and cash. For Meridian Corporation, paying $20,000 monthly decreases the lease liability while also affecting the cash. This reflects the cash outflow and liability reduction, aligning with International Financial Reporting Standards requirements for lease accounting, ensuring the asset-liability balance reflects actual economic events. Depreciating the right-of-use asset aligns with its usage over time. Meridian Corporation's $20,000 monthly depreciation ensures the asset's value decreases systematically, impacting the income statement through the depreciation expense. This reflects the asset's consumption and maintains compliance with International Financial Reporting Standards, highlighting how the asset contributes to operations over its useful life. Interest accrual on remaining lease liabilities reflects the cost of financing the lease arrangement. For Meridian Corporation, recognizing $3,000 in interest expense aligns with International Financial Reporting Standards guidelines, ensuring the financial impact of leasing extends beyond the initial asset and liability recognition. This maintains transparency about the cost of using leased assets over time. Revaluing the right-of-use asset ensures alignment with current market conditions. This $50,000 upward adjustment for Meridian Corporation increases asset value and revaluation surplus, reflecting enhanced asset worth. International Financial Reporting Standards supports such revaluations, ensuring the balance sheet accurately presents asset values, maintaining transparency in financial reporting. Year-end adjustments consolidate monthly transactions, ensuring Meridian Corporation's accounts reflect total annual activity. Recognizing $240,000 in depreciation and $36,000 in interest aligns with International Financial Reporting Standards by capturing asset use and financing costs comprehensively. These adjustments provide a complete picture of financial performance, crucial for accurate year-end reporting and analysis. Lease termination necessitates de-recognizing both the right-of-use asset and lease liability. Meridian Corporation's $960,000 derecognition aligns remaining balances, signaling lease completion. This step ensures all related financial impacts are nullified, adhering to International Financial Reporting Standards that mandate the removal of expired contracts from financial statements, maintaining accuracy and relevance. Every Big Four and investment bank interview on IAS 1 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. IAS 1 sets the framework for financial statements, ensuring consistency and comparability. Its core objective is to provide a structured presentation, helping stakeholders make informed decisions. A common pitfall is confusing this with specific measurement rules. Remember, IAS 1 is about presentation, not measurement, and ensures clarity in financial reporting. The statement of financial position highlights a company's assets, liabilities, and equity, providing a snapshot of financial health. It's crucial for assessing liquidity and solvency. A common mistake is equating it with profit or loss. Remember, this statement reflects financial standing at a point in time, not performance. Dividends declared but unpaid are recorded as a liability, reflecting the obligation to pay shareholders. IAS 1 requires showing this under current liabilities due to its short-term nature. A common error is omitting it, impacting liabilities accuracy. Ensure such dividends are recognized when declared, not paid, maintaining financial integrity. While both aim for transparency, Indian accounting standard often enhances disclosures, providing more details on management judgments and estimates. A frequent confusion is assuming identical disclosures. However, Indian accounting standard might require additional notes. Emphasize that while core principles align, nuances in disclosure can vary significantly. Revaluation of assets affects both the statement of financial position and other comprehensive income. Increases in value are credited to revaluation surplus, part of equity. A common error is misclassifying gains as profit. Always allocate gains to other comprehensive income, ensuring accurate financial portrayal without affecting net income. Working capital is the difference between current assets and current liabilities. For instance, if current assets are $150,000 and current liabilities are $100,000, working capital is $50,000. A common trap is neglecting non-current portions, skewing liquidity analysis. Focus on current classifications for an accurate working capital assessment. Yes, notes are required, providing essential context for financial data. They detail accounting policies and assumptions, minimizing misinterpretation. A frequent oversight is ignoring their significance, leading to incomplete analysis. Memorize that notes enhance understanding by explaining figures, ensuring transparency, and aiding stakeholder decision-making. IAS 1 mandates disclosing judgments made in applying accounting policies, affecting reported amounts. This includes assumptions about future events and other key estimations. A common pitfall is underdisclosure, risking transparency. Always ensure management's significant judgments are clearly articulated, providing stakeholders clarity on financial decisions. Confusion often arises from failing to distinguish between current and non-current liabilities. Non-current liabilities are obligations due beyond 1 year, while current liabilities are due within a year. Misclassifying these affects liquidity ratios. Remember, accurate classification aligns with due dates, ensuring clear financial reporting and analysis. IAS 1 sets the foundations for financial statement presentation. It ensures consistency, comparability, and clarity across periods and entities. Covering key definitions such as assets, liabilities, and income, it mandates fair presentation and the accrual basis of accounting. Only material information needs disclosure, supporting transparency without clutter. Consistency in presentation is crucial unless compelling reasons dictate changes, ensuring users get a reliable financial snapshot. IAS 1 lays out core presentation elements with a focus on liquidity and performance. Balance sheets separate current from non-current items. Profit and loss accounts capture operational outcomes, while comprehensive income reflects all income changes. The statement of changes in equity highlights equity movements. Cash flows break down operational, investing, and financing activities. Measurement rules dictate asset and liability values, with strict offsetting regulations for clarity. In interviews, watch for traps in presentation and disclosure. Consistent classification is key. Key differences with U.S. generally accepted accounting principles include the level of detail and emphasis on fair presentation. Disclose significant policies and judgments. Always assess going concern. Comparative figures are essential, providing at least 1 prior year. Understand the minimum content required: balance sheet, income statement, equity changes, cash flows, and notes. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.